This morning's session is about competition. So if you wanted resilience, it's next door. What we're going to do is have 4 pieces of research presented by myself. I'm Rob Nicholls. I'm a research fellow at the Centre for International Finance and Regulation. And my 2 colleagues, Associate Professor Deb Healy and Dr Marina Namer, both from UNSW Australia Law. I'll start off by presenting on the nature of competition in financial services. Then Deb will move on to a paper on the promotion of competition. Marina will discuss alternative forms of funding with a focus on crowdfunding. And I'll end up with a presentation on the balance between competition and stability in financial services. Essentially, these presentations are a report of work in progress on a project financed by the Centre for International Finance and Regulation called Competition Law and Policy in Australian Financial Services Regulation. Each of Deb, Marina and I are contributing to discussion of the extent to which there's scope for competition regulation, the balance of stability and competition, and issues such as sector-specific competition regulation. Ultimately, the research question for the project is, what are the optimal competition law and policy settings that should apply to the financial services sector? So the way that we're going to operate is to have each presentation running for about 15 minutes and an opportunity for questions after each presentation, and we'll have a 5-minute Q&A session. We'll then break into a wider discussion on competition issues that flow from the Murray Report, but also to some extent also on the Harper Competition Policy Review and the prospects of what will have emerged from the Tax White Paper. If you are asking questions, I'd ask that you, or contributing to the discussion, I'd ask that you identify yourself and the organisation for which you work. We've got these conference microphones, 1 per table. They are push to talk and latch. So when you finish answering, you need to hit the button again in order to stop the sub-comments that you're going to be making on the table afterwards being heard by everyone. So I'm going to start off by looking at the nature of competition in financial services. And this presentation is based on some work that I'm doing with my research assistant, Carolyn Evans, and I'd like to thank Carolyn for her work on this project. We all understand that the financial services sector, especially in retail banking, is a concentrated one. The epithet Big Four fits. So in considering the nature of competition in Australian financial services, we start by thinking about a highly concentrated sector. Of course, that leads to the question, is that bad? And I'll have a look at that and move on from there to look at competitiveness in the retail banking sector in Australia before thinking about the consequences of concentration and its interrelationship with the term bipartisan, and that came up in Chris Bowen's speech this morning, and it's a fairly rare word, but the bipartisan view of the 4 pillars policy. And I'll end by raising some issues on prospects for sector-specific intervention. So, is concentration bad? I suppose I have to start off in any look at a market by, if I'm going to talk about concentration, I'm going to have to define the market in which I'm looking at concentration. And I'm going to have a focus on the retail sector. So the ACCC's looked at this and its predecessor. In 1995, when reviewing the merger proposed between Westbank and Challenge Bank, it was a state-based bank in Western Australia, the Trade Practices Commission as it was then, adopted the view that the banking market was best examined as a cluster of banking services which were delivered by banks to their customers as a bundle. In 1997, however, the ACCC moved to a product-led approach, and this had regard to geographical and temporal considerations, and it found that most retail banking was reliant on branches and was therefore state-based, including in that branch structure, deposits and personal loan products. By 2000, though, the ACCC acknowledged that providers of personal loans can also distribute their products through non-branch means. And the geographic market for credit card issuing is likely to be, or at least approach, being a national market. Although the ACCC believed that deposit and transaction account markets should still be viewed as state-based. That market view was reiterated regularly in relation to proposed mergers relating to financial services, along with the underpinning view that in transaction accounts, SME and agribusiness, the presence of a branch in a convenient location and the extent of the ATM network are key considerations in choosing between financial institutions for these products. So we end up with concentration which is high, but also based on retail presence. Looking at whether Australian retail banking is competitive, again, back to fundamentals, competition and contestability arise when there are reasonably low barriers to both entry and exit from a sector. It's not clear that low barriers to entry exist in Australia, and evidence to support this view comes from the failure of international banks to gain a significant toehold in the retail banking sector. The Four Pillars policy creates a barrier to exit for at least each of ANZ, CBA, NAB and Westpac, except by way of a trade sale to likely an international bank and subject then to approval both by APRA and the Foreign Investment Review Board. Low margins in banking are used as evidence of competitiveness in the interim report of the Murray Inquiry are potentially a barrier to entry. The effect may be that competitive entry is only by industry disruptors. The Four Pillars policy has led to a degree of vertical integration in the sector, particularly in the sale of mortgage products. There was a contraction in the proportion of loans provided by banks other than the Big Four and by the non-bank mortgage sector associated with the global financial crisis. Since then, there has been a contraction in the diversity of mortgage intermediaries, with CBA acquiring 80% of Aussie home loans, Westpac acquiring the Rams brand and distribution business. Within the constraints of the Four Pillars policy, there have been recent acquisition by the Big Four banks, with Westpac's acquisition of St George and CBA's acquisition of Bankwest. There has also been a significant amount of horizontal integration in the sector in the areas of wealth management, insurance and specialised finance. There are major issues that flow from the horizontal and vertical integration in the banking sector. The primary one is that systemic risk becomes more domesticated and crosses multiple aspects of the Australian financial system. For example, NAB provides banking, wealth management, insurance through MLC, at least currently, and a range of wholesale superannuation products and services. The bank has the potential to be too big to fail, not just from its banking operations, but also from its impact in the superannuation sector. So, Does this concentration lead to unusual business models? Well, yes. If an outsider looked at the business models of Australian banks, they would probably think that their lending is primarily one of a mortgage provider. Although there are integrated offerings, the sector has residential and investment property at the heart of its lending risk. So, what do we see as an outcome of the Four Pillars policy? Well, the Four Pillars policy was articulated formally in 1990. There were 6 pillars back then, but it was currently 4. It was a reversal of a long-standing policy whereby the Reserve Bank of Australia had consistently waved through mergers and encouraged consolidation of the financial sector. The Pillars policy was first aimed at maintaining a separation of the 6 most significant financial services institutions in Australia. And at the time, those were the 4 largest banks and the 2 largest life insurance providers. Then Treasurer Paul Keating famously blocked a merger proposed between ANZ and National Mutual on the basis that it would reduce the effectiveness of competition. Importantly, as was noted later by the Wallace inquiry, the merger would almost certainly have been approved by the then Trade Practices Commission. In 1997, the policy was maintained, and contrary to the Wallace inquiry recommendations, the abolition recommendation of that inquiry was for the abolition of the 6 Pillars policy, although there were a number of groups against that abolition. But as a result of Wallace, the policy was modified to focus on preventing mergers between the 4 largest banks. Since then, we've had bipartisan support for the policy. Successive governments on both sides of the political spectrum have maintained the policy and the status of the 4 pillars, even against the urging of the 4 pillars themselves and implicit opposition from the wider financial industry. This slide charts the progress of the 10 largest surviving banks by volume of loans to households. The colour coding of the big 4 banks is pretty obvious, and the 4 pillars are very obviously the mainstays and continue to provide the bulk of loans to households. As is also apparent from this data, growth in the market for bank loans to households has been significant, and it's far exceeded the consumer price index. So since 2002, the volume of markets for loans to households has expanded by a factor of 5. In the same time, CPI has risen by 1/3. And this second slide shows that the number of banks competing to make loans to household has grown since 2002, but the extent to which they've gained a foothold is quite a different matter. And remember, in competition, it's the vibrancy of rivalry that it's important, not merely the number of rivals. So, looking at this still further, the 10 largest banks in 2014, we tracked back and looking where there's consistent data, and it shows that the lion's share of loans to households, around 70 to 75%, were held by the Big Four until 2009. That jumped after Westpac acquired St George, following an ACCC decision not to oppose the move, and has moved from 70 to 75 to 80 to 85% since. No major adjustments to market share have otherwise been observed, despite the contestable space created by this significant expansion of the volume of loans. So, should there be specific sector intervention? Short answer, no. I would argue that there should not be a difference in the way that competition policy is applied to the financial services sector than any other sector, except where there is a consumer welfare benefit of that happening, that it should be in the long-term interest of end users. From the work that we've done, we haven't seen an example of where a different approach would be justified. In assessing competition, in order to determine whether conduct has lessened competition, it's important to recognise that risk analysis is a critical driver of the conduct in the financial services sector. This means that a risk-weighted commercial decision would not be replicated by either a non-financial services firm or a financial services firm with different risk appetite. But that does not mean a different competition approach is appropriate. However, I think there are some specific sector-specific issues that have led to the potential for problems. The major issue is the same as the pre-GFC one. We don't know what the effect of any major industry disruption will be. What we probably have is an increasing risk that Australia has the potential, through the domestication of risk, of having a national financial crisis in the absence of a global or regional one. I'm not really sure how we prepare for that prospect. Well, thank you, ladies and gentlemen. I'd be happy to take questions.
John Morgan from UNSW and Allens. Rob, I just wonder, I mean, so one of the things that came up in the Murray inquiry was the integration of banks with the wealth management businesses that they now have, and the impact of that on competition more broadly, because when we just look at banks from the point of view of lenders of, in respect of home loans, we're really looking at just a very small fragment of their total business. And I was just wondering whether you've looked at the numbers when you add in the different roles they play in the wealth management sector.
To date, as I say, this is a work in progress. What we've focused on is looking at numbers in the retail sector. Part of the issue is extracting out wealth management as a line. The second is it's actually, I'm afraid this is a simplicity question, it's actually easier to assess what is the market for retail banking than it is even answering the question, what is wealth management? So as wealth management traverses a range of different activities, it's much less clear as to what the market is. What I think is important, though, is that the degree of integration of the wealth management businesses of each of the major retail banks means that there is a significant both vertical and horizontal integration within those banking services and aimed at a domestic market, so that the potential for wealth management to contribute to the domestication of systemic risk is significant. Any other questions? Very quiet audience. What I'd like to do then is to ask my colleague, Associate Professor Deb Healy, to present.
Good morning, and thank you, Rob. This presentation is, as Rob said, based on some work that I'm doing with him and with research assistant Charlotte Pennell, and I'd like to thank her for her work on this project. We're seeing a shift in approaches to regulation and to the regulation of financial services in other countries, notably the UK, where the responsibility for the promotion of competition in the financial services sector is given to the Financial Conduct Regulator. Now that's specific, it's not given to the Prudential Supervisor or to the Reserve Bank, which are actually one entity in the UK. Instead, it becomes the responsibility of the Securities Regulator. So in the early part of the FSI review, there was some debate as to whether competition in the financial services sector should be promoted, and if so, by whom. So my presentation here will look at some of the issues in that debate. I'll start off by considering whether competition should be promoted and then consider who's best placed to do the job. I'll look at some of the outcomes from the UK by considering the actions of the Financial Conduct Authority. I'll then look at some of the Australian structural issues that frame any solutions, which I've called peaks, pillars and problems, and I'll end up by looking at some potential options. So the first question is, should competition be promoted? Well, as a competition lawyer, I think that that goes without saying, but the Herfindahl-Hirschman Index is an internationally recognised indicator of market concentration, and this is a table which sets out the HHI of all bank loans to households as at 30th of June. It's calculated, for those of you who may not know, as the sum of the squares of the market shares of the 50 largest participating firms, or all of the firms if there are less than 50, and it's generally used in competition analysis in Australia by the ACCC, although as you can imagine we don't often have the 50 largest firms to consider, because there are very many markets where we have far less participants than that. What this approach does is it upweights the impact of the largest competitors, and the ACCC started using it. Prior to that, they would use the shares of the 4 largest market participants and compare them to the market size and the number of participants, but they decided that that didn't upweight the impact of the largest competitors enough, so they changed to this. So calculated this way, an HHI of less than or equal to 1,500 is generally viewed as indicating an acceptably concentrated market, i.e. a market that's unlikely to impede competition, while an HHI of around 2,000 or more is generally referred to as being problematic. So in 2014, the HHI on this table was 1893, indicating a moderately to highly concentrated market by international standards, and a material change from the earlier prevailing level of around 1,500. Factors like this probably led to the FSI inquiry saying that there was an adequate, reasonably adequate level of competition in banking in Australia, which is hardly a ringing endorsement for it. This increase originated in the acquisition of St George by Westpac in 2008, and as Rob said, and was reinforced by some GFC-related exits that have not been directly offset by new entrants gaining market share. Now, HHI as a measure for retail banking or any other sector where there is a limited number of competitors, such as domestic airlines, telecommunications, etc., has some issues. So as a consequence, we'll look at a couple of other measures. So this is the H statistic, and it's a measure which is more specific to the banking industry, and it's a measure of the elasticity of banking revenues relative to input prices. And as you can see, we have a slide on that here. There is limited Australian data, but this is the results for 2010. And based on the H statistic for 2010, it could reasonably be concluded that the US has a more competitive banking sector than the UK, and that the Australian banking competitiveness lies between the UK and the US, that is at a level that is comparable with the euro area and the world as a whole. But what is the trend? So this third slide relates to the Lerner Index for the banking sector. And that's another analysis of a firm's market power, where perfect competition is designated as 0, and the higher you go, the more market power you have. And it's available on the World Bank Global Financial Development Database. And there are some comparisons on this slide. This indicates that Australia's banking sector is more comparative than other geographic areas, that the UK reached the highest level of competitiveness in 2001, and that Australia's banking competitiveness peaked in 2004. However, the trend is in 2010 was decreasing rather than increasing competitiveness. And this suggests there could be opportunities to promote competition in the sector. And going back to the FSI report, you'll all recall that it said that competition was the primary support to the financial system, but must be set in the context of a strong strong policy framework. So who should promote competition? Well, to some extent, a call for the promotion of competition implies that prudential regulation, whether macro, micro, or both, is not delivering an optimum outcome. And we have some issues that overlap with the competition and stability balance that Rob will be addressing later. From the literature, in 2009, Arend, Merton and others, and an OECD 2010 report highlight the empirical analysis that leads to the argument that strong supervisors enhance not only stability but also competition. They note that the evidence shows that where supervisors are not very strong, capital requirements appear to hamper competition as the system can be abused, and that this creates an uneven playing field. That might suggest that APRA should be the body promoting competition. However, there is a strong theme in the competition and consumer law literature that suggests that competition and consumer policy share a common goal and purpose, which is the enhancement of consumer welfare. This is a fundamental issue. It suggests the promotion of competition for the benefit of long-term interests of end users, a test used in a number of regulated industries, may not be sufficient in all cases, and that's not too surprising, because in heavily intermediated sectors, such as the wholesale part of the provision of financial services, serving the long-term interests of intermediaries could have a detrimental effect on consumer welfare. There's also an acknowledgement that competition and consumer policy each play a different role and approach in attaining their objectives. For example, the OECD argues for competition and consumer authorities to be more integrated to prevent anti-competitive restrictions, and that's what's traditionally been the case in Australia, where competition lawyers have always argued that both aspects of the competition law are aimed at creating a level playing field for competition. The first by protecting consumers from misleading or deceptive or unfair practices, and the second by the market provisions. They all create a level playing field. There's also acknowledgement, in a separate report, the OECD suggests it may be beneficial for competition policy to be extended to not only consumer welfare but also economic and systemic stability, or otherwise for competition authorities to focus on consumer welfare whilst other institutions look at the importance of consumer welfare against other concerns. And the OECD report refers to countries that already have this system in place, such as Canada, the Netherlands and Switzerland, and the European framework, and it also gives the example of Austria, where concentration is permitted if it allows for international competitiveness and is sound in terms of macroeconomic stability. Now, we would traditionally have said, well, you know, that's industry policy, you're creating national champions, and we've always rejected that in Australia based on theories such as the theories of Porter, although, for those who look carefully, we do have a merger authorisation provision which looks at issues such as the significant increase in exports, substitution of domestic goods for imported goods, and all other relevant matters relating to the international competitiveness of Australian industry. So we're not completely lily-white on industrial policy criticisms. But taken together, perhaps the answer to the questions that we're asking looks more like a competition and consumer watchdog being the promoter of competition rather than a securities regulator. And I would have to agree with that. So the next thing I'll talk about briefly is what does the Financial Conduct Authority do? The Financial Conduct Authority in the UK uses market studies to look at sectors of the financial services sector in which competition seems not to be working. As set out on the slide, there have been 6 such areas in the 18 months since it's had the relevant powers. Before a market study starts, the Financial Conduct Authority identifies markets that don't appear to be working well using information from a range of sources, such as its own intelligence, past studies, internal papers and analyses, market intelligence and complaints from third parties. It assesses how well competition works in the interests of consumers. So consumer detriment is a major component in determining its priorities for market studies. Where it has a concern, it reviews the competition issues in greater detail and decides whether to launch a study. And it also assesses internally what it should cover, possible issues it will investigate, including the potential adverse effects on consumers and the possible drivers of those effects. Produces a project plan and establishes resources needed. It may also engage external consultants on particular aspects of the market study, for example, the scope. So, for example, the studies which it has done. But the SME retail banking study being conducted there is already in the hands of the competition regulator, the Competition and Markets Authority. From next month, the FCA will have concurrent competition powers. This means it will have powers under the UK Competition Act to enforce against and fine for breaches of domestic and EU competition law prohibitions on anti-competitive agreements and abuses of a dominant position, as well as the power to refer conduct to the CMA. So that's what they're doing in the UK, and it's relatively new, so I think it's probably difficult to draw any conclusions at this point as to how successful it has been or is likely to be. So, peaks, pillars and problems. The FSI report has not made recommendations as to structural changes in the regulatory framework. This means we have the twin peaks of separate prudential and securities regulation going forward. The absence of any merger of those bodies calls into question whether they could be called upon to promote competition. In any case, the reinforcement of the 4 pillars policy suggests there is a problem in expecting the existing financial services regulator to be able to promote competition. The focus on the 4 pillars by the 2 peaks creates a regulatory blind spot in relation to potential entry and exit. Unless both APRA and ASIC are provided with a new set of responsibilities and resources, they will not be in a position to promote competition. The findings of relevant Senate committees suggest that perhaps the responsibility for consumer protection in financial services products does not sit well with ASIC. While Murray has foreclosed some options for the promotion of competition, I will turn to some potential options. Now, my last point. I'm a competition law specialist. As a consequence, I understand how the ACCC works as both a competition regulator and a consumer law enforcement body. It seems to me that having the ACCC promote competition in the provision of financial services with the specific objective of maximising consumer welfare is a practical and reasonable approach. It also seems to me that it would be reasonable for the ACCC to have carriage of consumer protection across all sectors, including financial services. And as I finish, I'd like to make two more points. The FSI report suggests the removal of impediments to competition, which is hard to argue against. It requires regulators to be more sensitive to the impact of their decisions on competition, international competitiveness and the free flow of capital. And I think that that's a good idea. Regulators regulate in a vacuum. I'm not suggesting that they are turned into competition law experts overnight, but there must be a mechanism by which they can consider that impact and choose the less anti-competitive option. It also calls for them to identify rules and procedures that create barriers to competition and consider whether they can be moderated or removed. It also asks for an explicit mandate to ASIC to consider competition. And when I looked at that, I thought that was a secondary role to the role of the ACCC. I personally believe that the ACCC should be the prime competition regulator, but I don't think everyone else can be absolved from responsibility for considering at some point the competition law impact of the regulations and procedures that they're putting in place. And the last point I'd like to make, which you may find interesting, is that in some other research I've been doing for CIFR on bank mergers, I've had the opportunity to interview a large but not enormous number of regulators, banks, and people operating in the industry as lawyers and in other capacities. And one of my questions was, is the Australian banking environment competitive? And most people who responded to me said, yes, very competitive, which I find rather interesting because my observations of it and clearly what has been said in the FSI report are that it's adequately competitive, and that's possibly a generous characterisation. So thank you. Are there any questions for me before I finish? Yes. It's the mic in the middle of the table, yes. We're trying to trick you.
Okay, can you hear me? Thank you. Look, I just had a question for you in relation to the comment you made on regulators acting in a vacuum in Australia. I work in one regulatory field, but it's certainly not the financial sector, so I qualify it by that. But I'm aware that between APRA, ASIC, ACCC, there's a lot of liaison, a lot of co-regulation. And we, in fact, have a Council of Financial Regulators. So can you just expand on that point?
I don't think that regulators in general, and I'm not, I understand that there are various levels of cooperation, but I really don't think that on a day-to-day basis people look at the impact of their regulation on competition. They may in a very big way, but I don't think they do it on a day-to-day basis. I don't think government generally looks at the impact of other regulation that it imposes. So it's more of a general statement, not picking particularly on those three groups.
Thank you for the comment, but I think if you spent any time inside any of the regulators, you'd find that to be a very simplistic statement.
Well,
and I'd encourage you to make that overture before you finalise your papers.
Oops, sorry. Okay. Well, we'll have to disagree on that because I see all sorts of levels of legislation which have been done slightly differently and would have but maybe we can continue this discussion later. Are there any other questions? Thank you.
Okay, I'd like to invite Marina Namer to come to the podium and present.
Thank you, Rob. I will be talking to you about crowdfunding and especially crowd equity funding. And this is part of the CIFR project with Rob and Deb. So with crowdfunding, as you know, this concept comes from two sources, crowdsourcing and microlending. And crowdfunding allows a number of people to provide small amount of money to fund a particular cause or for a particular purpose. And as you can see, sorry, I'm losing my voice, which is not fun. As you can see, there are different types of crowdfunding that do exist, and these different types, you can have donations where people actually donate money for a particular cause, reward, pre-sale, and this is, for example, in businesses, they want to raise certain money so they can say, we're going to produce a particular product, so why don't you buy the product before you actually, before it's actually produced, so that would be pre-sale. And peer-to-peer lending, where people are lending certain money to businesses, and equity crowdfunding. My focus will be on equity crowdfunding. However, it's very important to remember the other types of crowdfunding that do exist because we can learn a lot from that experience. Now, crowd equity funding has become very important and people are talking about it more and more because it has the potential to solve a particular problem. And the problem is with small and medium businesses. Now, these small and medium businesses play a very important role in our economy. However, there is a problem. Now, they don't have enough access to finance. And this can be for a range of reasons, such as failure to match potential sources of capital with potential investors' opportunity. And crowdfunding might allow to help this because it will allow a business to target a huge range of people and attract different investors. Unavailability of traditional sources of for small business financing, and global financial crisis. During the global financial crisis, we saw a number of practices that may not have been very desirable, and as a result, we have new capital adequacy requirements that are or will be implemented in the coming years. So this will put more strain on financing small and medium enterprises. Now, so yes, there is a potential for crowd equity funding to actually solve this problem. So do we need to actually regulate it? And the answer is definitely we do, because there is a range of issues that arise with crowdfunding in general and crowd equity funding in particular. One of them is fraud. Now, so fraud is a high risk in any type of venture, but in crowdfunding it can be quite problematic. And we have been seeing more recently over the last few months a number of crowdfunding that are being done in the form of donation. There are lots of fraudulent activities that are happening. The latest one was a woman who wanted to raise capital for her cancer treatment, and she managed to raise it through crowdfunding, $300,000 to cover her treatment. And then it was discovered later on that she didn't have cancer. And the question is, where did that money go? So that's why it's very important to monitor it from that perspective. Another one is business failure. Now, with business failure, business fail all the time, small business in particular. Now, with crowd funding, it's even a bigger problem because here it's more businesses trying to pitch an idea and trying to see if there is engagement with that idea. And when they get the money, they have to turn this idea into a viable business and go ahead with it. This is especially the case with startups. And we have been seeing examples of that, for example, in crowdfunding with pre-sale. And one example, which actually ended up a success story, is there was a business who had a design for a very, very good bike. And people would get very excited about it if they do bicycles and all these things. And they went to crowdfunding and they said, this is the product that we want to produce, why don't you invest in us? And lots of people invested. Basically, they wanted only around $200,000. They received $600,000 of money, and they were very excited about it. They had the money. They can produce these bikes. Now, that was great, but then they realized we actually need to produce the bikes. How to do it? They didn't have the production chain in place. So they had to learn, where do I do the manufacturing? What will be the cost? And all these things. So it was a very steep learning curve for them. They managed to do it in the end of the day, but they were supposed to produce the bike within 6 months. It took them 1.5 years to do. And that was a success story. There were a number of cases where people just couldn't do anything with it. They failed in providing the products that they promised to provide. So as a result, there is this risk of fraud and business failure with crowdfunding. So that's why we need to regulate it. But then the question comes, okay, we know we need to regulate it. How do we regulate it? What regulation do we want? The regulation that we need to have need to be a real balance between stability, ensuring protection of consumers, that consumer confidence remain there, market integrity, and competition, allowing more businesses to be able to raise money through that, so that way they will be able to enter the market, be more competitive, and so on. So we have these two imperatives that are very, very important. And finding the right balance is very difficult. And we have been seeing this from experiences of different countries that have been adopting legislation regarding crowd equity funding. Some of them go toward let's help competition, some of them go towards stability, and they kill crowdfunding in doing that. One country in particular is Italy. Italy introduced crowd equity funding laws, and they are very interesting because they impose a huge range of regulation that make crowdfunding very, very difficult to actually take place. So they have, for businesses, there is an imperative that you can only be one particular type of business, so innovative startups. These are the only businesses that will be able to do it. Now they have a certain amount of money that they can actually raise. Intermediaries, they have a huge range of regulation that apply to them. And investors, now they have limited the scope of investment, how much they can invest in crowd equity funding, which is fine, but they went further than that by saying, on top of that, the investors need to sit for a test to make sure they can actually invest. And they know what they are doing, so they understand the risk. But they didn't stop there. They went further than that and said, in addition to that, at the end of the crowd equity funding, the business need to prove that they have 5% of their capital invested with a sophisticated investor or a professional investor. And that will show the investors, retail investors, that there is confidence in the market. So it's very hard for all these regulations, all these requirements to actually be ticked to go forward. And I'm told, I haven't looked at the test because I don't read Italian, but I'm told by people who have looked at the test that investors sit for, it's quite a complex test that probably a person with a PhD might be able to do it.